Now we're getting into traffic. Hi, Brenda.
Hi, how are you?
Good. Hi, Sydney.
Hello, sir.
All right. Hunter is here. Hi, Hunter.
Hello.
Okay, we'll wait another moment here and see if Teddy shows up with a few others. And then we'll get going into a tricky little area of adjusting journal entries. We're up to chapter 4 now, right? So I will share my screen here. You can see that, Brenda?
Yes, we can.
Okay. Oh, here's Teddy. Hi, Teddy.
Hey, Bob, how are you?
All right, I guess we're ready to start rolling here. We have a big chapter in front of us. Okay, we're going to get into the area of adjusting journal entries and a worksheet that we use to prepare them. And we'll talk all about them. Oops, let me click that down. Explain the accrual basis of accounting and the reason for adjusting journal entries. Okay. We can divide the economic life of a business into artificial time periods, right? A business is said to be a continuing entity. It goes on forever and ever and ever until the owners decide to stop the operation. But what we can do is we can cut it down into like a 1 month period and then measure how they did for that 1 month. Or we can do it for 1 quarter or for 1 year. So what we're going to try to talk about are the adjusting entries needed to get the best result on the financial statements. And this is repetitive, but super important. Companies recognize revenue when the services are performed. It has nothing to do. Oh, I'm sorry. I didn't even see they were asking a question. The periodicity. Forget periodicity. Periodicity is just the concept that you can split the business into small areas. Revenue. Now here's where I was going until I interrupted myself. Revenue is recognized when you perform the obligation, when you provide the service. Then you can record the revenue. Until then, you don't have anything. Revenue recognition, identify the contract with the owners, the contract, the legal liability agreement between two parties. Wow, look at all this. Good Lord. Just in summary, you have a contract with your customers. Identify exactly what you're supposed to do to earn the money, come up with the price, and then you perform the service and recognize the revenue. Expense recognition principle. Companies, hold on a second, I knocked this off. Companies recognize expenses in the period in which they make the effort to generate the revenue. Let the expenses follow the revenues. Here are just a couple of Here are a couple of GAAP terms. Revenue recognition principle, we just talked about that. Expense recognition principle. Expenses when the company makes efforts to regenerate those revenues. Recognize expenses with revenues in the period when the company makes efforts to generate those revenues. What is the matching principle? Revenues and expenses. Matching principle, revenues and expenses. Which of the following about the accrual basis of accounting is false? Revenues, the events that occur. Obviously, D is wrong. Revenue is recorded only when cash is received. No, cash has nothing to do with it, okay? Accrual-based accounting, once again, we're doing everything when they occur. We're not worried about when the cash changes hands. Transactions recorded in the periods in which they occur. We recognize revenues when we perform the services rather than when we receive cash. Expenses are recognized when incurred. In other words, when experienced. And this is all part of proper GAAP accounting. Cash basis accounting, we're not going to be teaching that at all. It's not GAAP. No sustainable business could possibly run on a cash basis unless it was a real tiny little place that didn't care about borrowing money or attracting investors. To ensure that revenue recognition and expense recognition principles are followed, we need to prepare what are called adjusting journal entries. They're necessary because the trial balance may not contain up-to-date and complete information. The trial balance that comes out at the end of the month, by definition, is wrong. By definition, it's wrong and it's incomplete because it does not have journal entries that can only be done at the end of the month. And that's what we're talking about in this chapter. Journal entries, these adjusting entries are required every time a company prepares the statements. And every one of these entries will have one balance sheet and one income statement account. Why do we need to do them? They're made to ensure that expenses are recognized in the right period, revenues in the right period, and that the accounting, that the balance sheet and income statement have the correct balance at the end of the accounting period. All those responses are true. Okay. Okay, well, let's see if we can divide and conquer first of all. First of all, we have two types of adjusting journal entries, deferrals and accruals. Prepaid expenses. You remember your prepaid insurance, everybody? Prepaid insurance. That is a deferral. Expenses paid in cash before they are used or consumed. Unearned revenue, cash received before services are performed. Deferral, deferred. The word defer means to put off to the future. What we're saying with a deferral is money changed hands, but nobody has done anything yet, okay? Money has changed hands, nobody's done anything. Prepaid insurance, you have an asset sitting there, right? A $12,000 insurance policy you bought in December. When you bought the policy, you debited an asset called prepaid insurance. Going forward, you have to reduce that asset every month by $1,000 because now you're getting the benefit of that insurance policy. So that's our first adjusting journal entry. We're going to take the prepaids and credit them and debit the resulting expense. Unearned revenue, this is cash you receive in advance before doing anything. When you get that money, you're going to debit cash and credit a liability account. That's interesting, huh? We receive cash in the mail and it creates a liability. The liability is not in cash, though. The liability is in playing baseball games, or the liability is in performing a concert. Keep in mind that a prepaid expense and an unearned revenue are the same thing. They're the same thing. It just depends on what side of the transaction you are. Prepaid expense, you bought an insurance policy. You debited an asset called prepaid insurance and you credited cash. The person who sold you the policy did the opposite. They debited cash and credited that liability account, okay? So deferreds, money changed hands in advance, but nobody's done anything. The service was deferred. Accrued revenues refer to those expenses which we have experienced already, but we haven't recorded them or paid them yet, okay? That could be like the payroll for the last week of the month, the electric bill or something like that. So you could have accrued expenses like salaries and wages, electricity, other things. And you could have accrued revenue, mainly interest. If you loan somebody money, they owe you interest. So they're just showing you a trial balance here. I'm not exactly sure why. So this is your beginning trial balance, okay? This is the trial balance we worked with in chapter 3. We know it is incomplete. Below is a list of time in the left column with the description of the concept. There are more description. Provide the description. Let's just do this together. Accrual-based accounting, you record the transactions when they occur. Calendar year just happens to be the same as a fiscal year beginning January 1st. Periodicity, period. That's where you can break things out. F into C. What's C? What was F? Yeah. Accounts divide the economic life of a business into artificial periods. B, revenues expenses when they are recorded. So that's just a little brief introduction. We are saying to ourselves, we have a trial balance that is not complete and needs to be adjusted. So let's do our deferrals. What do we say the deferrals were? The prepaids and the unearned income, unearned liability. So now we're traveling along through the accounting cycle. In the prior chapters, we learned to analyze, journalize, post journal entries to the general ledger, and run a trial balance. We then use that trial balance to prepare the financial statements. Now we're saying that trial balance is incomplete and requires adjusting journal entries that must be posted. Prepaid. Payment of expenses that are recorded as an asset to show the service or benefit you're going to get in the future. Prepaid insurance, prepaid supplies, prepaid advertising. You can see you have a whole bunch of them. Prepaid rent. These are the ones where you paid for the service, but you're not getting it yet until the future. And the best example I can give you is prepaid insurance. So take a look here. Prepaid expenses, they expire with the passing of time. So what is our adjusting entry? We have to recognize insurance expense in my example. We're going to debit an expense called insurance expense, and we're going to credit the prepaid asset. So we have that $12,000 policy sitting there in January. At the end of January, that asset's only going to be 11,000, 10,000, 9,000, etc., month by month until the end of the year, where the asset goes down to zero and the total expense for the year was 12,000. Sierra bought supplies costing 2,500. They recorded the payment by debiting the prepaid supplies account. This account shows a balance of 2,500 on the trial balance, but an inventory count reveals there's 1,000. So we understand what happened there? On October 1st, we bought supplies. And at that point, those supplies were an asset because we had not used them. Now they're saying they went out and counted 1,000 of them. So that means we used 1,500, right? We had 25. We had 1,000 left. Look at your first adjusting journal entry. You debit supplies expense and you credit prepaid supplies. Your adjusting journal entries are pretty much a search for unrecorded expenses, okay? And they're showing you a big fancy example here. We bought the supplies for $1,500, or rather we bought the supplies for 2,500. Now we've used 1,500. So what's our journal entry? We're going to debit supplies expense for 1,500, and we're going to reduce the supplies by 1,500. So that at the end of the month, the balance in supplies is $1,000, which is what it should be. And the expense for the month is $1,500, which represents the number of supplies we used. Here's the old insurance policy. They paid for a one-year insurance policy, and they're going to divide that by 12. The policy coverage begins October 1st. That's when they bought the policy. So 600 divided by 12 is $50. You see what we're doing here? We're reducing the asset for the passage of time. We're crediting the asset, prepaid insurance, debiting the insurance expense. And here it is in some detail. Look at your T account. I'm sorry, guys. Look at your T account. We debit insurance expense. We credit prepaid insurance. That means at the end of the month, the balance of prepaid insurance has dropped to $550. At the end of next month, it's going to go down to $500, etc. Let's talk about another deferred depreciation expense. Depreciation. It's the process of allocating the cost of an asset to expense over its useful life. Depreciation has nothing to do with the actual change in the value of the asset. It's an allocation, not a valuation concept. Assume that depreciation on an equipment is $480 a year or $40 a month, okay? What is our journal entry going to be? We're going to debit depreciation expense, and we're crediting a new account called accumulated depreciation. That equipment that we bought many years ago, we're never going to credit it. You never credit the original cost of the asset. But we have to reduce the cost of that asset using accumulated depreciation, which is a contra asset account. It is an asset account, but it carries a normal debit balance. So any contra account is always married to somebody. In this case, accumulated depreciation is married to the equipment. So our journal entry is a debit to depreciation expense, a credit to accumulated depreciation. This, I think, is the easiest adjusting journal entry because it's always the same two accounts, no exception. Debit depreciation expense, credit accumulated depreciation. And here it is. The debit increases expenses and the credit to accumulated depreciation decreases assets. Assets go down because we're crediting an asset account. Now here they're showing it again. Debit depreciation expense, credit accumulated depreciation. You notice that we never credit the original cost of the asset. That $5,000 is going to be there forever. Accumulated depreciation, it's a contra asset account. The book value is the difference between the accumulated depreciation and the original cost. What did we pay for this asset? $5,000, right? How much did we depreciate the first month? $40. Net book value is $4,960. Accounting for prepaid expenses. Supplies, reason for the adjustment. Prepaid expenses have been used. We have to record the amount that's been used. Before we do that, the assets would be overstated, expenses would be understated. So we're going to debit an expense and credit an asset. You're always going to debit an expense with one little exception. Unearned revenue. Unearned revenue occurs in regard to rent. You went out and you bought airline tickets for your Christmas vacation, maybe at the end of the year. Well, when the airlines got your check, they debited cash and they credited unearned ticket revenue because they can't call it revenue on their income statement until that plane is in the air. So take a peek at the journal entry. We are going to debit that liability account called the unearned revenue and credit regular revenue. Credit regular revenue. Sierra received $1,200 on October 2nd for advertising expenses expected to be done by the end of the year. Unearned service revenue had a balance of $1,200. Analysis revealed the company performed $400 of that amount. There's your adjusting journal entry. You debit unearned revenue, $400, credit service revenue. Now, I know this is a tricky little area, and it's going to take you a little bit of time when you start doing some homework problems to get the hang of it. But if you keep in mind that it's always a debit to an expense and probably a credit to an asset, that'll make things a lot easier for you. And here we go with the unearned service revenue, debit 400, credit service revenue. Accounting for unearned revenue. What are we talking about? Rent, magazines. These are all businesses where subscribers and customers pay in advance for future events. Unearned revenues recorded in liability are now recognized as revenues when the service is performed. If we didn't make that entry, liabilities would be overstated, revenues would be understated. So there's our journal entry. We debit liabilities, credit revenues. Prepare the adjusting entries here. Let me read. I gotta get this out of my way. Prepare the adjusting entries. Well, let's take a look at it. An analysis of the account shows the following. Insurance expires at the rate of 100 per month. How much do they have in insurance? 3,600, right? So we're going to have to write an entry to debit insurance expense and credit the prepaid insurance to bring that down to 3,500. Supplies on hand total 800. Well, they had 2,800 on the trial balance. That means they used 2,000. We're going to debit supplies expense and credit the prepaid supplies. The equipment depreciates $200 a month. That's the one I said is easy. That's the debit to depreciation expense and the credit to accumulated depreciation. And now we had some unearned revenue, 9,200 sitting there, but it turns out during the month, we put on a couple of concerts and we earned 4,000 of that 9,200. So now you're talking a debit to the liability account and a credit to earned revenue. So let's take a look at them here. Insurance expires at the rate of $100 per month. That shouldn't be too hard. You debit insurance expense and you credit the prepaid insurance. These prepaid assets have to be reduced every month as we use them, right? Supplies on hand totaled 800. Again, we have to take the balance down from 2,800 to 800. We do that with this journal entry here. The equipment depreciates 200 a month. They're giving it to us. You debit depreciation expense, you credit accumulated depreciation. And now we have the unearned revenue of 4,000. We get rid of that liability because we don't owe them the concerts anymore. And we credit the revenue. So those are the deferreds. We just went through the deferrals, the ones where money changed hands, but nobody did anything to earn anything yet. Now let's get into the world of accruals, okay? Accruals. Accruals are made to record revenue for services performed but not yet recorded, expenses incurred but not yet paid. So you see the difference between a deferral and an accrual? A deferral, money changed hands in advance. Here, nobody's paid anything, but we have already incurred the expense. We've experienced it. Revenues for services performed but not yet received in cash or recorded. The revenue is recorded before the cash receipt. And what we're talking about with revenue pretty much is interest income. So imagine we loaned money to somebody and they owe us interest every month. They owe us, say, $100 interest every month. Well, they're not going to pay that year's interest until the end of the year, but we have to record that income. So we're going to debit the asset for $100, whatever, and credit the revenue account. We're going to debit interest receivable and credit interest revenue. Here we go. We perform services, but we haven't billed them out to a customer. We better make sure we record that. That's not really an adjusting entry. We know that from chapter 1. Accounting for accrued revenues, interest, rent. Assets would be understated, revenues would be understated if we did not do these things. Expenses incurred but not yet paid. This could be your electric bills, utilities, accrued expenses, taxes, interest, salaries. Let's talk about salaries. You've all been out in the workforce. We're all working people at one time or another, probably right now. The last week of the month you worked and you make $100 a day. The last week you made $100, $500. Well, you're not going to get paid for that for a week or two, right? But you worked those hours this month. You worked those hours last week, from the 26th of September through the 30th. We have to record that expense in September. And we're going to do that with a debit to an expense and a credit to a liability account called an accrual account. Here's an example. We're going to accrue some expense. Sierra Corp signed a 3-month payable in the amount of $5,000. We have to pay back $5,000 in 3 months. The note is 12%. Whenever you see a percentage, that means it's for a whole year. So 12% of $5,000 is $600. 5,000 times 12% is $6,000 divided by 1 month to get into 1 month, $50 interest per month. So in the month of October, we have to recognize that we incurred $50 of expense. $50. We're going to debit interest expense and credit accrued interest payable. Okay. Anybody have questions? Feel free to stop me if you think I'm going too fast or you don't understand something. Here we go. Here's the one you guys should be familiar with. Here, these people worked from the 26th through the 31st of October. That is where the expense should go. That is where the expense should go. These people get paid every 2 weeks, it looks like. So on the 15th through the 25th through the 26th, that's the end of the pay period. Starting with the 26th, starting with the 29th, the 30th and the 31st, we have to say to ourselves, we earn the money, this person earned the money in October. That's where the expense begins, October, not November. So we're going to debit salaries and wages expense, and we're going to credit an accrual called salaries and wages payable. This person earned $1,200 in the last 3 days of the month, or it's the company earned that, company employees. Debit the expense, credit the wages payable. That $4,000 you see there, that was the balance that was already paid and received by the employees, making their total payroll $5,200. So, I mean, this is an interesting one to look at here. This might help you understand it. Prepaid expenses. If we don't reduce the prepaid expenses, our assets are overstated and our expenses are understated. So your journal entry, debit to an expense, credit to an asset. Unearned revenue. You got to get rid of the liability from what you earned with a debit, credit revenues. Accrued revenue. This is probably interest income. You debit interest receivable, credit interest income. Accrued expenses could be anything. Debit salaries and wages expense, credit accrued wages payable. Debit electricity expense, credit accrued payables. Microcomputer systems began operations and they prepare financial statements. The company owed its employees $800 in wages that are going to be paid on September 1. We have to accrue that $800. The company borrowed money from a local bank and the annual interest rate is 10%. We have to accrue that interest. And then we did some revenue for services performed but unrecorded. So these are your three basic accrual entries. We owed the employees 800 at the end of the month, but that was work they did in September. They're not going to get paid till October, or the end of September, rather. So we're going to debit salaries and wages expense and credit the 800. On August 1st, the company borrowed 30,000 from a local bank. It's a 15-year mortgage. So that's 10% times 30,000. That's 3,000 a year. 3,000 a year in interest expense, or $250 a month. We debit interest expense, we credit the interest payable. Prepare the adjusting journal entries needed. Revenue. Revenue for services performed but not recorded. You debit receivables or cash, credit service revenue. Okay, that's when we got the money. Okay, so that took us through adjusting journal entries. And I warn you, they're going to be tricky. They're going to make you think. But once you get the hang of it, it's not too bad. So now let's assume we did all of our adjusting entries and we did them all correctly. Now we're going to run another trial balance. This one is complete and correct. So we're going to prepare an adjusted trial balance and closing entries. So, wow, look how far we're getting toward the end of the cycle, huh? Getting close. Now we're going to look at an adjusted trial balance. And here is your adjusted trial balance. The numbers in red are the ones that had adjustments made to them. Remember, we adjusted $200 for interest income. We had the supplies, the prepaid insurance. We hit, these are the entries we hit. So now we have a new, complete, correct trial balance. Which of the following is incorrect? I don't like those questions that are incorrect. Preparing financial statements. They're so sorry, guys. Got happy fingers for some reason. Prepare your financial statements from the trial balance. Financial statements are prepared directly. So here we go. We know how to do this already, right? This was on your test and everything. We know that everything starting with your first revenue account is the income statement. It's the income statement. So we just bring over the 10,600 in income in revenue minus all these expenses, gives you net income of 2,860. Now we do the income statement first because we have to bring that 2,860 over to the retained earnings statement. And your beginning retained earnings was 0. You add the net income, you subtract the dividend, which you see right there, and now you have a new retained earnings number. You've done 2 of the 3 statements. Now we're ready for the balance sheet. And the only thing you do with the balance sheet is you copy everything from here, everything except what? Retained earnings, because the retained earnings changed from whatever the number was here, 0, changed from 0 to 2,360. So in our balance sheet, we're going to see 2,360. Okay. This part, I think you guys are pretty good on putting together the statements. Skolnick was organized on April 1st. Yeah, I'm barely touching this darn keyboard. Keep my fingers off it. The company prepares quarterly financials. The adjusted trial balance are shown below. Okay, so they're giving us a trial balance, but the problem is they're mixing up the accounts. You notice that? It's not done in the proper order. Normally, the trial balance is done assets, liabilities, equity, revenues, expenses. Here they jumbled them up because they wanted us to pick them out one by one. So let's have a little fun with this. Determine the net income for the quarter April to June. Revenues. Well, let's go back. I see revenues of 14,200. Let's pick out our expenses. I see salaries and wages, 94. Depreciation was 850. etc. Pull them right out of there. And there is your income statement, $2,490. Then we can determine the total assets and liabilities. And that's a look at the brief part of your balance sheet. Determine the amount of retained earnings at the end of the period. Well, we know that the retained earnings at the beginning was, let's go back, I want to look. Oh, for heaven's sake. Retained earnings. Let's see if we can find retained earnings was zero. Retained earnings was zero. We had net income of $24.90 minus the dividends, $18.90. And then we'd be able to do the balance sheet after that. Now, here we go. We're getting near the end. I'm giving you a new area to look at. Closing entries. Closing entries. You have temporary and permanent accounts. We closed the temporary accounts. What are the temporary accounts? Your revenues and expenses. What are your temporary accounts? Revenues and expenses, and the dividends if you had any. The balance sheet, assets, liabilities, equity, you never close them. Now, what do we mean by closing? We have to take that net income. We have to take that net income of $2,490 and move it out of the expenses and revenues into retained earnings. That's the mechanism. The closing entries are the mechanism to move the net income into your equity account. And it's fairly simple, as long as you understand why we're doing them. All we're going to do now is we're going to start with the revenues. We're going to take the revenue, and revenues have a normal credit balance, right? Credit balance. We're going to debit the revenue account, and we're going to credit income summary, which is a temporary account. We're going to take all of the expenses, all of them, put them in a journal entry format, and we're going to credit them to take them out of their normal balance and put that into income summary. At that point, the net income is sitting in the income summary account, which can then be transferred to retained earnings. Closing entries formally recognize in the ledger the transfer of net income to retained earnings and owner's drawings. We don't have drawings in this class. We produce a zero value in each of these accounts and generally journalized, posted at the end of the month. So here's what we're doing. We're putting the revenues and the expense accounts into an account called income summary. When we do that, this will represent the net income. This will represent the net income because we put the revenues and expenses in. And as you know, revenues and expenses represent the net income. Then when we have the net income in the income summary, we can zero it out and move it into retained earnings. Dividends, we close directly to retained earnings. So take a peek. Revenue has a credit balance, right? Revenue has a credit balance. So how do we zero it out? With a debit. Now we have no more service revenue. We now credit income summary. Income summary. We do the same thing with the expenses, except the expenses have a normal debit balance. So we're going to credit them. We're going to credit each expense and debit income summary. The difference between the two is our 2200 something, 2860 net income. We're closing out the net income now to retained earnings. That's all there is to it, really. And the dividends, they go right into, they serve to reduce retained earnings with the debit. Okay. So they're just showing you in grid form the entries. The easy way to do it is in 4 steps. Do it in 4 steps. Step 1, revenue. Take all your revenue accounts. In this case, we had, I guess, just one, right? We take all the revenue accounts. We debit them out. We debit them out here, and we credit income summary. So your sales are now here. We take all of the expenses, which have a normal debit balance, and we zero them out with a credit. And that brings all the expenses over to the income summary. Now, expenses subtracted from revenue gives us the net income, which we can now bring over step 3 to the retained earnings. Step 4, zero out the dividends. So not too bad if you think of it in 4 steps, okay? Summary of the accounting cycle. This is what they've been showing. This is what they've been showing us with those arrows. Analyze business transactions, journalize, post. So we're already up to the end. Whether you realize or not, we've covered the entire accounting cycle. We started off in chapter 1 by analyzing simple transactions. We learned how to write journal entries. We learned how to post the journal entries to the ledger. We learned how to prepare a trial balance. And now in this chapter, we're picking it up with steps 5 through 9. We journalize and post our adjusting journal entries. We come up with an adjusted trial balance. We can do the financial statements. And now we can post the closing entries and a final trial balance. It's quite a lot in this chapter, though. It's quite a lot. Prepare the closing entries. Well, let's look at this. Haskell has the following balance. What do we close, did we say? Revenues and expenses. We don't close accounts payable. We do close revenue. We do close rent expense. Anything called expense we close, supplies expense. You never close accounts receivable. You never close retained earnings, and you do close the dividends. So we're going to have to debit service revenue. We're going to have to credit rent, salaries, and supplies. Debit service revenue, $98,000. Credit the 3 expenses: salaries and wage expense, rent expense, 52, supplies expense. We're just about done with that. Now all we have to do is take the balance of the income summary, which is 98,000 minus 80, which would be 18,000. We get rid of the income summary and we close to retained earnings. We made a profit, so retained earnings goes up with a credit. And then dividends get closed directly to retained earnings. Now, there's a worksheet that we'll be putting together that does some of this work for us, okay? The worksheet, multi-column form, not a permanent record. Let's just take a quick look at this. I'm not sure if we need to go over it, but here's what we're talking about. You're going to create a trial balance. The month ends, right? And as soon as the month ends, you're going to create a trial balance. And you're going to post it on this 10-column worksheet, 10 columns. The first 2 columns are the trial balance. The second 2 columns are your adjustments. We're going to take the beginning trial balance you had here, debit and credit the adjustments to get the new trial balance. And then you'll be able to put the income statement over here and the balance sheet up here. Wow, look how complicated that looks, huh? But let's just take a peek real quick. Cash, you never adjust cash. You never adjust cash. It's not like supplies. We don't send someone out to the safe and say, count the money there. And you come back and say, there's only $15,000. Okay, we write off 200. No, cash is to the penny. But let's get familiar with this. If I was teaching this class in the classroom, I would continue with my policy of giving out this item here. So let's see what we have. We got supplies of 2,500, but we used, oh, I'm so sorry, guys. We used 1,500, right? So what's the new balance? 1,000. Insurance, we used 50. Our new balance is 550. Unearned revenue, we earned 400 of it. So that gets us down to 8. You get the idea? The adjusted trial balance now is the tool to prepare the income statement and the balance sheet. You can draw a line right above sales revenue. Everything below that is your income statement. Everything above it is the balance sheet. As simple as that, okay? And we're not going to get into IFRS. We don't worry about that. Well, that was a pretty daunting chapter, wouldn't you think? What do you think, Brenda? You followed everything perfectly?
I think so, hopefully.
Yeah, when you start doing the homework, it'll click a little bit more. I mean, it's tricky stuff. You just have to remember we have these prepaid assets and now we're using them. These assets are going away. We have to say to ourselves, this asset has now been reduced by the amount of how much was taken out. So you're going to be debiting an expense and crediting an asset most likely, okay? Anybody have any questions, anything?
Would you remind me where we can find the slideshows?
Oh, there's 2 places to find them. One is on my website, Bob Smagula YouTube website. Hard to say that without giggling. And the other one is the in Canvas. Cornelia posts them right in Canvas, right in the module.
Okay, thank you.
That's where you find them, okay? All right, well, with that in mind, I'm going to stop sharing. And let's see who's here. Oh, hi, Mark. How you doing? I see Miguel's here. Hi, Hunter. Okay, I guess we'll take off, guys, okay?
Thank you, Bob. I appreciate it.
Thank you very much. We'll see you later, guys.
Thank you.
Thank you.
You're all
Thank
welcome.
you.
Thank you, sir.
Bye.
Off we go.
Take care.